Thank you very much for joining us. Obviously, it's 1 o'clock on the 21st of September. Anyone who's listened to playback, this is equally appropriate to anybody really who's looking to reduce the tax they pay. And as I say, you have until the 31st of October to take advantage of some of the areas that I'm going to cover off today. What I want to do is just give you a kind of, for those of you that have not listened to us before, my colleague Ruth is going to put into the chat function webinars and how to access some of the previous webinars that we've done, and do keep an eye out for any future ones. We have webinars coming up. The next one we're doing is actually on budget day, which is the 10th of October. It's going to be a 15-minute one at 4 o'clock, just to give you kind of a real sense of how the budget may have affected you. So it is something to look out for. For those of you that are not familiar with Alpha Wealth, we're a progressive financial services company, Cork-centric, although we have a small presence in Dublin. We have 10 financial advisors giving independent guidance in all areas of personal finance. Myself, Cleaner, who's on the call as well, and also one of my colleagues, David Looney, who's another of the financial advisors who does some of the financial wellness webinars that we give, both to individuals and companies. So just to get into it, there's kind of three main areas and headlines that I want to cover off today. The first of which is ways in which to reduce the tax you pay. The second is helping people, I suppose, basically compartmentalize their finances into short, medium and long term, and how best to meet their financial goals. And then finally, how to help you retire early. One of the main objectives that we have with people that we work with is helping them to basically reduce the number of years that they have to work for. So if you're in your 20s and 30s, how to basically get to a point, possibly from 50 onwards. And obviously for those of you that are a bit older, making sure that you don't have to work into your 60s. And it's one of the things that we absolutely aspire to help people with.
So Nick, we've had one or two questions in over the week. And the first one is, and I might just put this to you before you start, what is the best thing to do to start a financial plan?
Okay, and I would encourage all of you, if you can, please feel free to ask any questions. We try to make these sessions as informative as possible. And obviously, we would encourage you, if you can, please do put them into the Q&A and they will be addressed during the webinar. So I say this to everybody, all of us should complete a financial budgeter at least once a year. If you haven't already done it, I would encourage you to download one. You can use your own. There are many available online. They are free to do. Or indeed, my colleague Ruth will put into the chat a link as to how to access a really good one that we suggest people use. And it's a great way of you just, I suppose, getting a better sense of exactly how much is brought into the household, whether it be through the child allowance, through rental income that you earn, earned income from yourself and possibly a partner, and then how that money is being allocated each month. And whilst it might seem a little bit mundane, it's a really powerful exercise. And what I would say is that when doing it, try and think about every item that you put on the expenditures. Is there a way in which you can get the same thing for less? Do you need to spend that money? A lot of us have, for example, subscriptions going to the likes of Apple TV and so on. I know myself from personal experience. And I find sometimes like these are things that we just sign up to and we don't necessarily use. And I think it's a great way of just, I suppose, coming to terms with what you feel is really important. The other aspect of this then is enabling a financial planner to help you in terms of reducing some of those costs, which I will touch upon as we go through this review. So really, to answer the question, the best thing to do is complete a budgeter. It'll give you a real sense of how to best make sure that you can allocate the money that is left over to the various things that you want to try and achieve. Just to go through this, and again, I'm not going to sort of label on each of the points here, and I can provide these presentation slides to anybody, and indeed a copy of the video for people to listen back to, or indeed maybe it might be relevant to your partner or anyone else that you might think would benefit from this. The main aspects and topics I'm going to really focus on today are reducing the tax you pay, and there's really kind of two main ways that most of us can reduce the tax that we pay, which is basically a pension, or there's a government-backed scheme called the Employment Investment Incentive Scheme. In addition to this, all of us should be using the Revenue Online system. It's a really simple I suppose, way in which we can reduce some of the taxes that we pay. And I'm going to touch on that as we go through this as well. And again, please do feel free to ask any questions. So let's talk about pensions. Pensions is kind of a little bit of a, I suppose, a misnomer in that we were speaking to actually a company earlier, and they had quite a young cohort of staff, and they said that they weren't really that enamored about pensions. And what I was trying to explain to them is that the way of looking at pensions are, they're just a savings vehicle that you can use, which is really tax effective, that will enable you to retire early. So typically from the age of 50, these pensions can be accessed. So if you're working for a company, and if you stay with that company until 50, or if you leave the company early, the money that you accumulate in that pension fund can be accessed from that time onwards. The main advantage of a pension, as you can hopefully see on the screen, is that if you're earning over 40,000 a year in Ireland, you will be liable to 52% on everything you get above that. And the way in which you can mitigate against it is by making a contribution to a pension. I use the figure of 10,000 as an illustration. That figure could be 1,000 or it could be 100 euros. You would get back 40% pretty much immediately. And you have until the end of October to make a contribution to your existing pension or to a new pension arrangement where you'll get back that 40%. And we can explain to you how in more detail and where best to place those funds. If you're in a company pension arrangement, for example, there are different options in terms of the funds that will allow you to invest in. And the benefit of the pension as well is that it grows tax-free from now until you reach that time that you look to draw it down. And it's a really great way of you achieving what I call financial freedom. Okay, so if people want to, again, revert back to us directly, and it's really something that we happily do for you, I can show you what you should be looking to try and achieve in terms of your pension fund. People often ask me, well, Nick, what's the magic number? What should I be aiming for? And I always say like 400,000 in today's money should be an aspiration for people to try and achieve. And you might say, well, why 400,000? Typically, if any of us get to 55, 60, 65 years of age, and you can determine what age you draw this pension down, if you had 400,000 in today's money, that would entitle you to 100,000 tax-free and 300,000 of which you can choose how much of that money you want to take as an income. And we can help you understand what that would look like. But in addition to the state pension and perhaps any other assets that you have, in my opinion, that should entitle you not to have to work, or certainly not to the same level. Moving on then, in respect of other things that you can reduce tax on, some people have taken out something called income protection. This is basically a product that's sold by my industry, which pays a percentage of your income if you're unable to work. And some of you may have taken out this policy and not be claiming tax relief on it. It is eligible to get back 40% of the cost on the monthly premium, but also life assurance. Many of us were forced to take out life cover when we took out a mortgage, but some of us may have also taken out additional life cover, and it is important to know that you can get tax relief on that. And if anyone wants more information, again, not to repeat myself, please do feel free to either drop a message into the Q&A or indeed get in touch with us after this.
So Nick, I'm going to pop in with a question that's just come in. It's to achieve a pension of 35,000 per annum, how much of a fund would someone need to do so?
Thank you very much for the question. The figure would be approximately around 500,000 as a pot, which again can be made up of cumulative different pension funds or indeed any other forms of income that you may have. And you might say, well, how can you be so definitive? Taking the example I used earlier, if you had 500,000 in your pension, you'll be entitled to a quarter of it tax-free. That's 125,000 that you can supplement income that you take. The balance of which obviously would be 375,000. And at an average drawdown rate of about 8%, that would give you your 35,000 a year. I can show you the maths on this, obviously separately if you wanted, but typically that would be the figure that would be required. And the key thing is that you can control how you draw that income down. So you can basically increase it if needs be, or reduce it depending on your personal circumstances. Just to get on to the second area, and probably one of the biggest areas that we are saying to people they should look to try and take opportunity of, is that if you are a high rate taxpayer, i.e. earning over 40,000 a year, and if you want to look at a complement to your pension, there is a scheme called the Employment Investment Incentive Scheme, or EAAS as it's commonly known, which has been available for about 15 years now, where you can make a personal investment. You need to have money in the bank to do this, I should add. And if you were to make a contribution to one of the qualifying companies, there's about 50 or so companies each year that raise this type of finance, the Irish government will give you back 40%. So on the example of 10,000, 4,000 euros. And at the end of the 5-year period, I'm going to earn 5 years, it's a minimum 4 years, that you expect to get your 10,000 euros plus interest. Now, the examples, again, I'm going to just touch on are 2 of the 3 that are listed here. One of them is Blacks of Kinsale. It's a whiskey IPA company that are based in Cork, and also the 5 Mile Inn. And it might sound a bit strange, you know, hearing about companies like 5 Mile. Basically, it's a restaurant bar just outside Middleton in Cork. But it really is an attractive proposition in respect of the way in which this restaurant is going to be refurbished, the revenue streams that they expect, both from the rotisserie that they're going to do as an add-on that's currently available in terms of an opportunity in a number of bars and hotels around the country, and how they're expecting to generate returns for investors over that 4 to 5 years. In respect of Blacks of Kinsale, they've just completed I suppose a new multi-distillery plant, which is again on the screen there for those who can see it, which they're going to enable them to increase their profits. They're currently generating a profit of about 600,000 a year on a turnover of about 2 million a year. And that's going to enable them to redeem people who are investing money in Blacks, to enable them to continue to grow into the future. Again, we can provide you with a lot more information about these 2 companies and why we feel very strongly that they make sense for people who have money, that they are in a position where they can invest over that period, and most importantly, get that 40% back from the Irish government.
So Nick, I'm going to stop you there again before you move on to the case studies. So another question has come in from somebody who said that their role was made redundant this year at the end of June, and they were on a company pension scheme with Irish Life. Can they still make the pension contribution lump sum for this tax year? And also, what do you recommend regarding pension contributions during this gap now whilst finding work?
I'm sorry to hear about the redundancy. Unfortunately, there have been quite a few employees that have been made left go, and we've done a few sessions with some of the companies, namely Twitter being one of the most prominent ones, who also have their pensions with Irish Life, as it so happens. So to answer the question, yes, you can make a pension contribution, not into that scheme if you've left that employment, but into a standalone pension scheme. And this is something that we can discuss with you and facilitate, I should add, where the most important thing is to make sure that you're in the best pension that you can get. I would be more in favour of Zurich than I would Irish Life, and we operate as an independent broker, but also that you're availing it at the lowest cost possible. And again, I would like you to see us as a very low cost financial services provider. You have until the end of October to make that contribution. So for example, this goes back to tax that you would have paid last year. And revenue allow very generous limits to employees and to self-employed individuals, where if you're in your 30s, you can pay up to 20% of what you earned last year into a pension. So let's say you were earning 50,000 euros a year, 20% of that is 10,000 euros. If you've only made a contribution to your pension for last year of say 5,000, you have between now and the end of October to make up that difference of 5,000, getting this immediate tax reclaim of 2,000 euros. In respect to the question around what do they do in the period before they take up employment and perhaps go through probation, which can take typically 6 months, you absolutely have the ability to make pension contributions. And again, depending on the amount of income that you earn this year, and the tax year runs from November to October, so it's what you would have earned from last November up to this October, you can certainly make pension contributions. Typically, for most employees that are in that probationary period, what I generally suggest to them is that if they are taking up employment with a new company, is to save the money and to deploy it into their new company pension arrangement when they become eligible. And I can explain to you how you can work that. But basically what you're doing is you're just going to, I suppose, make a balloon payment into that pension scheme when you become eligible for the scheme.
I have one more question. Is there a limit on the 25% lump sum you can draw down tax-free? At the moment, my pension is estimated to be worth 800,000 at retirement. Also, what age is the earliest that you can draw down the lump sum?
So you can draw down a lump sum pension typically from age 50. You would have to have left unemployment in order to do so. With respect to the question around is 25% the limit, it generally tends to be, unless you have previous pension schemes from previous employments, which I'm not really in favour of you trying to amalgamate. A lot of people try to bring pensions into one scheme. It generally isn't advisable. Let's say, for example, you had worked for a company for 5 years and built up a pension fund of, say, 20, 30, 40,000 euros. You may be able to draw a lot more than the 25% from that one particular scheme. But in the overall sense, and in relation to the particular question, the 25% on 800,000 typically would be the limit. That's 200,000. However, if the scheme value goes up above that, the cap is 200,000. So what I'm saying there is that if, let's say, you have a pension fund worth €1 million, 25% of that is 250,000. The tax-free cash element is capped at 200. 50,000 of that money would be taxed at 20%. You would therefore suffer a tax of 10,000 on that amount that you'd receive. But it's quite a low tax rate, and it shouldn't stop somebody aiming for a pension north of 800,000. But again, it's more of a case of trying to understand that, and I'll be happy to go through that with you separately if that's something of interest. Just to move on to the case studies, and thank you so much for the questions, guys, and please do feel free to continue to ask questions. We will cover them off later on. So these case studies are real life. I've done these reviews with clients over the last number of weeks. I've changed the names, obviously, and photographs, but just to give you some sort of context to some of the things that we do with our clients. This particular individual was 30 years of age, earning around 40,000 a year. The first thing I always ask people is, what are your financial objectives? In this particular case, it was to buy a property in the next 3 to 5 years, not wanting to work beyond 60, and trying to get rid of a car loan. They found it difficult to kind of get rid of debt. One of the things I say about debt, by the way, guys, is that it is one of the best ways that you can save is to pay down the debt that you have. We've obviously seen a massive hike in interest rates over the last 13 or 14 months. I'd like to suggest that if you do have debt, let's say a credit card, a personal loan, a car loan, you should focus on trying to get rid of those. And the easiest way to do it is start with the smallest one, which tends to be the most expensive, and try and pay it down as soon as possible. And once that happens, you start with the next one and so on, typically leaving your mortgage to the end. People do need guidance around mortgages, which I'll touch on in a second. But in this instance, what I said to this particular individual is they needed to try and save certainly for the next 3 to 5 years. Whilst there are certain government schemes available, like the Help to Buy scheme, and if anyone is looking to try and buy a property in the next 12 to 36 months, do speak to me. We don't provide mortgages in Alpha Wealth, but we give independent mortgage guidance to people and help them get into the best position possible, whereby you might be able to buy a house immediately by the fact that you may be entitled to the Help to Buy scheme, which will entitle you to up to 30,000 euros on tax that you've been paying over the last 4 years. And as long as you've been paying rent, that could be used in against the, I suppose, the capacity that the bank would need to see you in terms of lending you the money. So people who are saving for a deposit, that may not actually be necessary. And there has been a relaxation of the rules where you can now use the Help to Buy scheme for a self-build if that's something that anyone is looking to embark on. With this particular individual, what we did was we took advantage of the increase in interest rates that the banks are providing. So AIB currently provide 3% for their online saver, which is the market best rate at the moment. And what we did was we blended that in with the savings plan over a slightly longer period of 3 to 5 years, which was basically giving them the best of both worlds. We provide independent guidance in terms of putting people in touch with the best mortgage brokers, depending on what your circumstances require. And then for this particular individual, Mary, I spoke to her about making more of a contribution into her pension, which she could well afford to do, wasn't going to jeopardize her mortgage application in any way, shape, or form. And again, we were going to look to review that as time went on, but she was going to benefit from the tax relief and building up more of a fund while she could afford to do so. Just in terms of the next example, and again, you'll get a better sense of like the way in which we operate. This was a couple in their early 40s, already had a mortgage with AIB. But what I was saying to them is that because they were coming off a good fixed rate 12 months from now, they were going to find themselves in 12 months' time on a much more expensive rate. So what we did was we spoke to AIB. This was about 3 months ago now. They were entitled to get a green rate. They had a good BR rating. And we fixed for 5 years at 3.75%. There was no hassle to them. There was no cost involved. They didn't have to do anything. And they saved about 120 euros on what was going to become at least a 5% rate that they were going to find themselves in. Probably more. We now have seen, obviously, the base rates for the banks is at 4.5, and mortgage interest rates are going to continue to rise. So for anyone who does have a mortgage, particularly a tracker or a fixed rate that's coming close to expiry, I would encourage you to reach out to us and let us show you how you can do better for yourselves by contacting your own bank. In addition, we were able to save this couple money on their mortgage protection. Mortgage protection is a product that you have to buy if you take out a mortgage. I found so many people spend way too much on policies that they don't need. The only legal requirement you have is to insure your lives for the amount that you borrow over the term that you borrow that for. But unfortunately, a lot of financial advisors, they add what I call bells and whistles onto these policies, and they don't particularly provide them at a discounted rate. So again, in this instance, this couple were paying 71 euros a month. We managed to get them a cover for 24 euros a month. And as well as that, we also reduced the cost of health insurance, which is not a product that we provide, but we absolutely help people save money. I have 4 children. I've only ever paid for one of them by taking advantage of discounts through the providers. I've always looked for online discounts, and I always make sure that I get the most appropriate policy for me based on what I'm looking for. I came across a couple, again, a few weeks ago where they were paying about 600 euros a year for health insurance, weren't really sure what it was covering them for, and one of the individuals had to go to hospital and they weren't covered in any of the private hospitals. And I explained to them that unfortunately there is a kind of a sweet spot for health insurance. There's no point paying realistically less than about 850 euros a year for health insurance because it won't be worth the paper it's written on. And I don't think it's worthwhile paying in excess of 2,000 euros a year either, because I think that that tends to get into, unless you're, I suppose, in the older age category. I've been very careful to say. I'm 50 later this year, by the way, so I feel I can say that. But it's more about making sure that you have the fit for purpose plan for you. And again, this is something that we can help you with, and making sure that you save as much money as possible. Finally, this is one individual that was getting close to the time they wanted to try and finish working. And the simple piece of advice that I gave them is that they didn't understand that their company's pension contribution did not count towards the overall limit. So again, this is age related. As you get older, revenue allow you to pay more. They thought that in their late 50s, the 35% included their employer's contribution. It doesn't. So this particular individual, all I said to them is, you pay up to the maximum 35%. You make up for the shortfall last year, which they did. And they also had some money available in the bank to take advantage of the EAAS scheme, which I mentioned earlier. And by doing those things, they were able to boost their pension pot by about 100,000 euros, because they were going to continue to do this for the next 4 to 5 years. And obviously, you take advantage of the EIS scheme whilst it's still available. We understand that next year may be the last one. So it is something that we are encouraging people to at least make themselves aware of. Finally, and please do feel free to pop any further questions into the Q&A, guys. But on tax credits, I find there's a lot of people that don't use the Revenue Online system, and I'm not particularly, au fait with the system. I certainly wasn't up until a few months ago. But what I would say to you all is it's so easy, and having done it myself, I can say to you genuinely, you can set up an account within seconds. You can go into the system. I can show you how to do this, or one of my colleagues in Alpha Wealth can absolutely assist you with this, and there's no cost to you of reaching out to us, where we can show you how to apply for the relevant credits that you should do so. Any of you that worked at home, particularly during the COVID years, should be looking to make a claim for some of the expenses that you incurred. I mentioned earlier about the rent tax credit. It's like €1,000 for an individual for last year and this year, and applies for a further 2 years. It would be madness for you not to apply for that. And if you're in a couple, that's doubled. So it'd be €1,000 for last year and so on. And again, these are really simple things that you can do. So just to summarize, we can help you save money on mortgages, mortgage protection, house, car, insurance. I spoke about paying back loans and how best to achieve that. In terms of pensions, I think it's really important for people to understand how a pension works. And again, it's really simple, but my industry makes it more complicated than it needs to be. Looking at any previous pension arrangements that you may have, making sure that you're in the most appropriate funds for you. I generally tend to say to people that the longer you have until you're going to draw your pension, the more risk you should accept. It's relevant to what you're prepared to accept as an individual. If you've got 20, 30 years to retire, you should be in a high-risk fund, and that is absolute. In respect of savings, I've touched on savings today. As I say, the main focus today was to try and help you reduce tax, but there are some really good savings accounts available, which we'd like to talk to you about, whether it be short-term within the banks, whether it be medium-term through the likes of the insurance companies like Zurich. They have some really attractive accounts available, and we can show you how to best navigate those. Finally, just in terms of what Alpha Wealth can offer you, we offer anybody that's been on any of the webinars, and the code is up there on the screen. It's available until the end of September, Alpha 50, where you can book a financial review with us, the normal cost of which is €199. We discount that to €99 for anyone on the call, and it sets out exactly what I've described to you today. We show you basically where you are currently. We show you your financial plans. We show you how to save money, to make your money work harder, and how you can put this kind of roadmap, as I call it, in place. However, if anyone has any questions, and if they just want to get clarification on something, just pop me an email or reach out to us. There is no fee for you to do so. My contact details on the screen there. Easiest way to get hold of me is through my email, which is nick@alphawealth.ie. So that's basically what I wanted to cover off today. I think I've been exactly 30 minutes. For anyone who missed part of this presentation, I'm more than happy, as I say, to provide the webinar video to anyone who would like to listen back to it. There are, as I say, further videos that we're doing, the next one being on the 10th of October, obviously budget day at 4 p.m, which my colleague Ruth would have put details into the chat on. And if anyone would like to ask any questions into the Q&A, please do feel free to do so, and we'd be more than happy to answer them.
I have a question here. I read the deposit savings interest rates are to go up from the 1st of October. Do you have insights into where to get the best interest rates, and in particular, if any product would outperform state savings products, considering that they are tax-free?
Yeah, that's a really good question. So at the moment, AIB Online Saver is the best on the regular savings side. And then for lump sum deposits, so if someone has €5,000 sitting in the bank, and this is what I was saying earlier about compartmentalize your money, if you have committed expenses over the next 12, 24, 36 months, the best place for your money is the bank or the post office or the credit union. The best rates currently that I would look at if it were me is I would lock money up now for about 6 months. You get the equivalent of 1.5%, which is obviously 0.75. And you might say, well, why? There are some better rates out there. Some of the banks will offer me a better rate. But the fact of the matter is that interest rates are continuing to rise. We haven't seen the full effect of these rate rises in deposit terms. So I would be slow to lock money up for too long. And in relation to the post office, whilst their rates are also going up in October, their rates are still very poor. Their 10-year solidarity bond, for example, at its height about 4 years ago was paying 50%, 50. that rate fell dramatically down to 7.5%. Talk about a dramatic fall in rates. And for anyone who has looked into those rates around that level of 7.5, I would come out of it immediately. You're going to lose a lot of money to inflation. However, they are going back up. They've recently increased them from what was 10% up to 14%, but it's still way too low for me, and it's going to improve. So what I'm really saying to you here is that if it were me, I'd lock money up for no more than 6 months now, take advantage of a reasonable rate for them. But I do believe that in the next 3 to 6 months, rates will have improved again, and at that stage, take advantage of that. But I can send you a listing of the best bank rates currently available and help you to sort of navigate the different rates with the banks.
So in terms of the EWS scheme, you mentioned that you need to be a high rate taxpayer to qualify for this. Does it only include your employment income or other sources of income also taken into account?
So the one advantage of EWS over pensions is that it does include rental income and other sources of income, even pension income. So I would suggest that it might work very favorably for somebody, let's say, who is earning income from property, let's say, that they've rented, or maybe in their retirement years. So the short answer to the question is yes, it can be used for all sorts of income.
And how easy is it to claim the €4,000 back in tax?
It's really simple. So anyone who invests in the EWS scheme between now and the end of November, which is the deadline really for the scheme, you will get a certificate from ourselves, if it's done via Alpha Wealth, that you get within the first quarter of next year. And all you need to do then is just go on the ROS system and make the claim. It's so simple. We can do it for you if you wish, but it's really, really straightforward.
And just lastly then, is there a full list of the companies that are eligible? You've chosen 3 to run through there. Are there more companies that are eligible for the EWS?
There are more companies. There is not a list that's kind of published because companies can come to the market on any given day. There's no qualification to the company itself. They just have to tell revenue that they're looking to apply for the scheme, and they have to give them some evidence of how they're going to, I suppose, establish more employment in Ireland. The reason for the 3 companies that I've listed, though, are these are the only 3 that we would suggest that you would consider investing in. We would vet the companies. We have no bias to them. The fact that 2 of them are based in Cork, 1 of them in Dublin, has nothing to do with where I'm based myself. It's around the fact that we've got most confidence and information from these companies that we feel most confident about the fact that they are going to be in the best position possible to pay you back. And again, we send you their prospectuses, we give you informed information. But what I'm really saying to you here is that of the 50 plus companies in the market this year, I would look at 47 of them, just the 3 that I've listed.
That's it in terms of the questions.
Great. Well, thank you very much again for your time. And I do appreciate, obviously, I know some of you have heard from us before. If anyone does have any feedback and they would like to provide it, please do so. As I mentioned to you, if you want to take advantage of the offer on the full financial review that David and myself provide to clients, please do feel free to take advantage of that. Either email us directly or go through our website using the code that we listed. And again, if you have any queries or any questions, however trivial, please don't hesitate to come on to us. We do want to make sure that we are adding value, and we do appreciate the time and engagement.
There has been one more question, and I think if you're okay to take it, is it okay just to...
Absolutely, yeah. Please.
So I have a public service pension. In addition, I put €100 a week into an ABC with a current fund value of 48,000. Is it advisable to continue making contributions to the ABC when at retirement I will be paying 52% tax on withdrawals, albeit receive 40% tax relief on the way in? My understanding is that only a percentage of the ABC fund can be added tax-free to my gratuity. Hope this makes sense.
It does, and I think that's probably a question which I'd like to kind of delve a little bit deeper into. This notion, though, of you getting tax relief on a pension to pay it on the other side when you draw it, I don't profess to. The reason being is that, firstly, you made reference there about the tax-free element to the ABC. So you're not going to be paying tax on all of the money. But one of the biggest advantages of pensions is the fact that they grow tax-free for the years that they remain. So even if you only had a year when you're going to draw the scheme down, it makes sense to put money into an ABC because you get the 40% tax relief. And the growth of that money in that even 1 year alone is not going to be taxed by revenue. On top of that, one of the things I would say as well is that if you're in the public service, you might be eligible to buy back any years that you may be missing. And the ABC can be used to purchase those years. So sometimes it's an advantage to build up that pot to give you the position to be able to do so. But it depends on how much you're earning, because if you're a higher rate income earner, which it sounds to me that you probably are, making that contribution would be generally sensible, but it needs to go into the right fund. And this is something, again, that I can help you get a bit more of a steer on and help you to understand what exactly happens when you draw the money down. So thank you very much again for the questions. Thank you so much again for your time. As I said, if anyone would like to get the video or indeed the slides that we presented today, do get on to us. You can just email me directly, nick@alphawealth.ie. And please do look out for the next webinar, which is on the budget, 4 p.m. on the Tuesday, the 10th of October. Enjoy the rest of the day, and thanks again, guys.